Again, my name is Anthony Butler. With Art Jetter and Company. I'm the individual disability and critical illness specialist here. And today, once again, we have Brock Falconer, who is the Western Regional DI Manager with Illinois Mutual. We're going to talk about underwriting as far as disability insurance and placing impaired policies and saving adjusted offers. So with that, Brock, you want to go ahead and take it away?
Absolutely. I appreciate it and appreciate you guys' time today. We'll get you in and out of here quick. Our main goal here in this three-part series, this being the third part, is really just to build your understanding on kind of the underwriting and obviously coming from a carrier, the carrier's perspective of underwriting and getting you kind of behind that veiled curtain. Today, we're going to mainly focus on getting these impaired policies and or adjusted offers placed and ways to kind of save some of these cases that unfortunately in our morbidity realm, we do see a decent amount of these get adjusted as they go through underwriting. We'll get into some of the reasons for that, along with, again, some of the maneuvers and things you can do as a producer. And obviously, a lot of it will be in your partnership with our Art Jetter and Company and ways that they're going to maneuver stuff through the different underwriters of the carriers as well. But I think it's helpful for you guys to understand what Tony and his team are doing in that regard as well. Again, appreciate your time, and let's get into some info here. First off, just to give you an idea of kind of why things can kind of twist when a case goes in, for disability insurance, just note first off the main key, and I'll always reiterate this, pretty sure I've said it on every call, but field underwriting, underwriting in the field, and field underwriting are our best three top ways to sell disability insurance and to make sure that we're doing everything we can to set expectations. Just note that you always have an opportunity when any kind of medical information arises way ahead of an application to shop that information utilizing the professionals like Tony and his team at Art Jetter and Company to see where an offer would potentially come back and see which carrier or carriers are going to be kind of the leading opportunity based on that medical history. So always great to find out stuff up front. Just note, however, even if something comes in and we didn't find out about medical issues up front, oftentimes just by running a medical insurance bureau reports or MIP report, many call them a script check for any prescriptions that have been filled and or prescribed in the past 5 to 10 years, as well as a motor vehicle report. That stuff behind the scenes at the carrier will oftentimes uncover some stuff that maybe either wasn't disclosed up front on an application or in field underwriting, or maybe just wasn't really thought of as a major medical issue that would lead to any kind of need for adjustment. A great example being mental nervous conditions, anxiety, depression, work stress, that sort of stuff. Again, we're not talking about necessarily real life threatening and or even major, current medical issues that would really affect your policy. We're mainly talking about things that affect your insurance risk, because placing a policy today, whether that's for life insurance or disability insurance or long-term care, we know that really what we're doing is we're setting up an elongated risk profile, and the carrier, much like Illinois Mutual and any other carrier, is always going to take more of an insurance risk profile approach versus kind of the real life, hazards and risks of said medical condition that we think about as clients and even as insurance professionals ourselves. I'm sure when we got in the industry, some of our perspective changed on medical issues and really how severe they really are. There's also going to be a difference between disability insurance and life insurance. So mortality and morbidity are going to be underwritten differently because there are risks that would make you potentially unable to work, and therefore disability insurance would be triggered. But these aren't necessarily conditions or factors that would lead to your mortality rate coming down or dying earlier than what your assumed mortality rate should be. Vice versa. There are conditions that potentially are more risk averse as far as mortality that disability insurance isn't as concerned with because of the fact that if something were to happen, it is going to be more life threatening versus someone being unable to work. but just note that there are some differences as well. So just because someone came through as preferred for life insurance does not necessarily mean that they're going to be completely unscathed for disability insurance. Again, vice versa. If there's any issues with disability insurance underwriting, there's no guarantee that there's going to be a huge correlation to life insurance. There are a lot of similarities, but again, it's going to be a misnomer to assume that it's all going to be congruent. First off, when in a situation where, again, the unfortunate happened, we're in a situation where we're going to need to kind of resell something because we put in an initial application with an assumption on structure and price and availabilities of riders, so on and so forth. And now, unfortunately, based on some underwriting facts that were uncovered, we have an adjusted offer. First off, we need to have a refocus on what the hot buttons and motivators for the coverage ultimately are. For disability insurance overall, we typically were focusing on the fact that this is a fallback payroll with an ability to pay for our mortgage, utility, groceries, support our family, ultimately pay our medical bills, right? Because we know when we suffer a disabling event, likely there's a doctor or doctors involved, which is going to actually raise our day-to-day, month-to-month, and annual expenses because of copays, deductibles, coinsurance, and that sort of stuff. We need to, again, reiterate when going back to clients with an adjusted offer of what this disability insurance is really doing for them, because if not for them taking responsibility for their income protection, disability insurance, paycheck insurance, however we want to diagnose, treat it, box it, and put a ribbon around it, what is this going to be in replace of? Well, we know Plan A is the plan that most Americans have, which is the self-insurance plan, which means zero cost up front, but financially catastrophic should a disabling event happen. We're promoting Plan B, which ultimately is a small incremental amount of premium up front so that disabling event is not completely financially catastrophic, hopefully minimally felt and very easily financially gotten through. And that's really what we need to, again, try to reiterate as we approach an adjusted offer, which may have a higher premium and likely some other adjustments involved with it. Again, just a reiteration of what this disability insurance is doing for the client. Also, we need to talk about these needs as we establish, again, the hot buttons and the motivators versus really what the availability on the policy is. Typically, these line up. But for instance, sometimes people are really adamant about the fact that their biggest fear is a very long-term disability, which essentially is a very small percentage of overall disability claims, meaning long-term typically being longer than 5 years. You're looking at typically less than 20% of all claims last more than 5 years. But just note that that is oftentimes what the biggest fear is for clients, is that they would have that never recoverable disabling event. Just note that one of the main ways that carriers protect their risk is if a policy is applied for with a age 65 or age 67 benefit period. The carrier will often come back and say, well, we're going to go ahead and improve the amount you applied for. We're going to approve every other part of the policy. But to protect our risk because of these previous medical issues, we're only going to offer a 5-year benefit period. We feel like that's going to be a protection enough for us as a carrier to make sure that we can put this client's policy in force. Well, again, this is obviously a little bit different than the client's initial kind of hot button where they wanted to have the policy kind of fit for them. But just know, again, we need to go back in this kind of instance and make sure we point out that very few claims last beyond 5 years. With this 5-year policy, we are covering 80+% of all disability claims. And then on top of that, while we can appreciate the frustration and not getting exactly what you want, just note that this policy is buying you 60 months of preparatory time so that you can figure out your next move if there were to be a disabling event that was severe enough to take you beyond 5 years. Again, that's ultimately what disability insurance is, right? It's the ability to have the time to make informed decisions, to not have to empty your savings, retirement, short sell your assets, so on and so forth, And this is no different if you had an adjusted offer. Really, you're still able to buy an amount of time, but just maybe not as long of an amount of time as the client would have wanted. Also note, again, you're going to have a more cost-effective policy with a 5-year benefit period versus the age 67. So that typically will help our scenario there as well, because we're going to potentially be able to save the client some money, even though they're not getting exactly what they wanted. The adjustment actually is going to help their pocketbook too. Some of the biggest hurdles to overcome oftentimes are any relation to someone's back. So the leading cause of disability insurance is musculoskeletal. So we're talking about back, neck, and spine. Unfortunately, and this is very similarly focused on within the entire disability industry, not necessarily looked at exactly the same by each carrier, but just note from my experience, and I think Tony can definitely speak to this in the brokerage realm, a lot of carriers are going to have a similar focus, and that is the fact that if a client gets normal adjustments via a chiropractor on their back, oftentimes that will lead to an actual back exclusion on the policy. While this doesn't seem fair, because this adjustment typically is not in relation to any previous back injury, the issue lies in the fact that this is the exact same treatment or adjustment that someone would receive should they have a previous injury. So the problem in the carrier's eyes is there's no way to differentiate a treatment adjustment versus just an upkeep adjustment. What does not help us either is the fact that the chiropractic industry is one of probably the more heavily disputed medical industries out there, because there's as many proponents for the need and the use of chiropractic work as there are those that say that it could actually be harmful to individuals as well. So that obviously does not help carriers trying to establish risk profiles, especially when someone has some kind of relation to the leading cause of disability claim. So that can be a huge hurdle to get over, and one which we really need to, again, be putting ourselves in a situation where we're adept at really kind of changing the perception on what the overall reason for the purchase is, as well as why it's still a very strong option for them, and really the only option that they can truly know that they do have protection for the future. When we know that there's some medical issues, again, our main hope and desire is to set the expectations by doing a pre-qualification, and again, finding out with the team of experts that we partner with what the ultimate outcome would be. But we're not always able to do that. We need to also keep in mind the amount of accident versus injury claims. Note that the industry average is typically 90% of all claims are related to illness and 10% related to accident injury. So I said that the leading cause of claim is musculoskeletal issues, but just note that there are as many musculoskeletal issues in relation to illness as there is accident and injury. So even if you have a back exclusion, that is going to be an exclusion in relation to general injury and accident in relation to that back. Typically the exclusion language, and again, it's going to vary between carriers, and definitely don't take this as being the absolute, but typically that exclusion, even though it says that your back is excluded because of chiropractic visits and or a previous issue on your back, typically fracture, burns, and lacerations are still covered, as well as any kind of actual illness in relation to the back as well. So note that there's an importance to point out the amount of claims due to illness versus accident and injury, because oftentimes someone is looking to buy the coverage because of a carpal tunnel surgery and fear that that carpal tunnel syndrome is going to come back. Or again, they have some back disc issues and they want to get that covered. But, whether we're P&C agents or in another risk protection realm, we know that you're not able to insure the car after the accident. But my goodness, there's still a huge need for the insurance overall. because again, there's thousands of ways that people suffer disabling events and therefore trigger these policies. And we need to make sure that these clients understand while maybe the biggest motivator for the coverage is not going to be something that will fit within the coverage profile. Just note that there are still many, many ways, thousands upon thousands of ways that would still trigger a claim and therefore put them in a scenario where without a fallback payroll, they again have plan A, which is the self-insurance plan, and very detrimental to their ability to keep their income, assets, retirement, so on and so forth. Also note that Social Security as well as workers' comp, a lot of these other programs that people think are really going to be their go-to resource, and really they'll rely upon that versus purchasing an adjusted offer. Not going to be something that they should rely upon. Social Security only approves after multiple application periods, about 40 to 45% of overall claims. Your disabling event or your disability has to make you unable to do any job on the planet and or have a high potential to lead to death within the next few years. Very stringent definition to allow you to qualify for that benefit. Hence all the pro bono attorney placards on all the city buses talking about helping people get their Social Security disability claims. Workers' comp is only going to cover an accident at work, covers zero illness, as well as any accident that happens away from work. Great example of when I worked at one of the courier companies and people would hurt themselves on the weekend and hobble into work and then Monday morning pretend like they tripped out of their truck and hurt themselves just so they could potentially get that workers' comp claim. Not only is that not going to be paid because it's false, but on top of that, if you had an individual disability plan, you would have not had to suffer through that weekend of pain and injury just to try to chase down a workers' comp claim and a false one at that. Also, no group insurance at work, and I'm speaking group disability insurance. Number one is taxable, so therefore is going to be a much smaller benefit than one would expect. And similarly, this is not a portable benefit and one that we need to make sure that we at least bare minimum supplement with an individual plan to make sure if that client leaves their job, that they would have some portable disability insurance to go with them because they could not take the group. Again, reselling is one of the least favorite things anyone on the retail side could ever want to do, but just note that there's a huge need for the coverage. I hope we can be very, very easily able to describe the fact that someone's most important asset is their ability to work every day and bring in an income. And there's no guarantee, unfortunately, due to disabling events that happen to 1 out of 4 people during their working years, that that's going to happen. So really we're looking for protection for the working years and really trying to offer a benefit that, again, may not fit the initial hot button for why the coverage was wanted, but again, it's going to be the only responsible way to make sure that you have a check coming in should your initial payroll fall back. We do have money back guarantees after this investment in the policy due to the fact we have our return of premium rider. This can be kind of a game changer for you when working specifically with Illinois Mutual via our Jetter and Company to find disability options, because of the fact that when you can speak to a policy that will actually pay all your premiums back at retirement age, it's a little bit different in being able to describe it then as truly an investment product with a insurance policy attached to it, because of the fact that we as a carrier would hold your money and then pay it all back at retirement age, minus any claim dollars that you would have been paid if you ever actually go out on claim. Happens. This is what if insurance. We know that. We're well versed in that. Whether you've sold this or not, you know that life insurance is an absolute if it's a permanent policy. Long-term care is about as close to an absolute as you can get, as we're kept alive even though we're not functioning well by modern medicine. Disability insurance is an absolute what if. But again, the issue with the Plan A is the great cost up front, but the catastrophic financial effects of the what if on the backside. We don't want to adjust that and leverage the risk over the life of the working career, and hopefully have that money back rider on the backside as well that allows us to get all of our money back, because as we all know in our heart of hearts, this will never happen to us, or at least that's what we think. And if you were correct on that, all of your money is returned to you. So zero risk other than not being able to buy that triple venti latte every day. You're just going to have to maybe adjust to a tall latte every other day. And again, 4 to 4 chance of winning when you do have a money back DI policy with return of premium. Whether or not someone has an exclusion that they don't like, or an adjusted policy that doesn't fit all the parameters for what they were looking for, at least again they have a 1 out of 4 chance of purchasing the best thing they ever could have, because they trigger the policy during their working years, in which case they would reimburse everything they paid into it, with the fact that their benefit payout is much larger than their premium. And then the people with the 3 out of 4 chance that won't trigger this policy, again, get all of their money back at retirement age. So again, your money is always at work for you with the return of premium policy and rider, with the Illinois Mutual disability insurance available through Art Jetter and Company. And again, it's always nice when you're reselling something to really have a story like that, about having someone's money truly always work for them, even if it is in a carrier's hands for a period of years before it's returned to them. Quickly, want to just talk about ways that policies can be adjusted to really help with premium in case there is any kind of flat extra or premium rating. We can adjust the elimination period or deductible period. Oftentimes, people will start at a 90-day elimination period, meaning that you're not going to receive a check until day 120, because you start accruing benefits day 91. Oftentimes, we'll push this back to 180, maybe even 365 days to try to help with premium. Obviously, only for clients that could self-insure for that long and really wanted to save premium versus their ability to self-insure. We would remove, and sometimes have to remove, certain riders that can be tacked on, again, just to kind of bring premiums down and to make it maybe a little bit more of a vanilla contract, but again, an important one, because not having a contract is a lot worse than having a contract and not having some of the kind of luxury riders added on. We will, as a carrier, and this is across the board, based on certain medical conditions, potentially put in some language talking about a re-exploration period. Depending on what the condition is, maybe after 2 years, we would re-explore the possibility of either lowering or taking a rating completely off of a policy. Re-exploration is essentially a constant when it comes to tobacco use and build chart, so height weight disparities, because if you've been non-smoker for at least 12 months in medical records, we can remove the uptick in charge for smoker rating, as well as if you've kept weight off and had it medically documented for at least a year, we can lower or potentially even remove the rating should the height weight be back into normal realms. And then there's always future options to look at. Potentially if we don't have a re-exploration period available, maybe the health has changed 5 years from now and we can explore whether it makes sense to buy a new contract or potentially look to maybe adjust the old contract to really fit what the current needs are. Again, just note that Art Jetter and Company will help you adjust that thermostat. As Dad and Grandpa always said, don't touch that. Again, you can definitely look into that, but just note that you have professionals that you can partner with to really help set the stage for what's available now, what will be available later, and really what the options are moving forward, as well as potentially throughout the life of that contract. We just know that self-insuring is not the answer. Let's do everything we can to make sure that we're not putting our clients in a self-insuring necessity plan A type situation. Whatever we can do to at least get a minimum contingency plan in place to make sure that at least the foundation of the client's needs are covered, because we want to keep the mortgage paid, the lights on, and groceries on the table. And we want to make sure that that living death scenario, that's the same effect as if they died during their working years. But they're actually alive for it, but same effect on their family. New need for income, new need to pay bills, and really it's a scramble effect that is just as severe as, again, a life situation. but potentially worse for the client themselves because they're typically cognitively aware and watching it take place and unfold. Wanted to thank you guys for your time today. Tony, I'll let you finish this out, but just note that you're not going to find a better partnership than Jetter & Company, and I hope I brought some value to the table for you guys in trying to figure out ways to, again, pick up where some of the pieces fall with these impaired and adjusted offers through disability underwriting.
Brock, thank you so much. If any one of you are looking for a DI proposal request, feel free to give me a call here at 800-228-0008. My extension is 1032. That offer extends to any questions, comments, or concerns that you may have. Also, the 2 previous webinars that we've held, on your invite that you received for this one, there is a link there that you can click on to listen to those recordings. And this one will be available here in the upcoming future. So again, if you have any questions, feel free to give me a call here at 800-228-0008, extension 1032, or you could shoot me an email at di@jetter.com. Thank you and have a great week.